Bilal Hafeez joins us now to discuss. Macro Hive CEO and head of research. We need to talk about the politics. We need to talk about the Bank of England as well, because it's once again been in the market in significant size today. Let's start with the politics. Kwasi Kwarteng says he's not going anywhere. If he's going to keep his job, he needs to navigate his way through this process, a process of restoring credibility to the UK. How does he do that without delivering a massive U-turn on that mini budget?
I think he's in a very, very difficult position. And we have to sort of note that when people say, I'm not losing my job, it probably means within a few days they will. But the key thing is to get some kind of visibility around how they're going to fund these tax cuts, because the initial response to the tax cuts was this unfunded. The bond vigilantes come out and bond sell-off. So there has to be some visibility on how you fund those tax cuts. Or you could reverse the tax cuts as well.
Yep.
The other issue is the pension industry in the UK. How do you introduce some kind of stabilization measures that will prevent the unwind of hedges, destabilizing markets from the pension fund sector?
Let's talk about the pension fund sector in just a moment, and talk about how the Bank of England kind of deals with Monday morning. How do you think markets would respond to a change of chancellor and potentially a change of prime minister?
I think at the moment, the market, I think, would take it positively if there was a change, because that would imply that we'd get an unwind of the fiscal stimulus that was announced by the current administration. On top of that, whoever comes in, their primary mandate will be to stabilize markets. So people will be very clear that the job of the new government is stabilize markets rather than Liz Truss's administration, which is dash for growth. So I think the market would take it positively. And in fact, all the stories today swirling around that there possibly is some kind of U-turn, has seen the pound rally and gilts rally as well.
Hey, Bilal, it's Alex in New York. It's good to see you. Do we have an idea of where the pension funds are right now? Like, have they been able to unwind what they need to unwind?
It's hard to tell exactly because we don't get much information in public. What we do know is that there's been frantic conversations across all the major pension funds to do something to stabilize their hedges, and for banks and whoever has exposure to them to provide the appropriate facilities for them to sort of manage their books. So my sense is, given the scale of the move, given the size of the hedges they have, I think it's very difficult for them to have corrected everything in the space of a week or two. So I still think there's a significant amount to go from here. And half the issue here is pace. So if we get a slower move in yields in the next few months, if everything slows down, then you have an easier path. But if we do see another sharp rise in yields, then there's a much bigger problem for them.
So the details are these in terms of the action that the Bank of England has delivered today. It's bought 3.12 billion of index-linked bonds, linkers, and it's bought 1.65 billion of long-dated gilts, 30 years in the operation that it's conducted Thursday. Come Monday morning, if that facility doesn't exist, are we going to go back to having problems? You talk about the fact that it's going to take quite a while to unwind. Has the BOE's program, I think it was 13 days in total, 65 billion in theory, is that enough? Is that long enough of a duration to be able to actually stabilize the situation?
I think no, it's not enough. I mean, the problem here is that you have this uncertainty around how much of an unwind of hedges, what collateral changes have to occur. Nobody, frankly, knows, how much you have to, these pension players have to do. And so what you should do is have almost like an unlimited window where you don't say there's a deadline.
Isn't that QE though?
It potentially is. It is QE at one level, but on the other hand, it's financial stability as well. Because what we're saying here is that you don't want to compromise the pension industry. It's like bailing out pensioners. So it is a form of QE, but the aim of it is to preserve the pension sector, which is crucial in the short run. And so as a result, that ends up being the dominant factor.
So Bilal, that sounds a lot like the whatever it takes pledge from Mario Draghi kind of back in the day that really helped stabilize the fragmentation risk there. Is that what you think we're going to increasingly see? Is that central banks trying to tighten, trying to unwind, while the governments have to deal with a fiscal crisis? They can raise rates, but they have to backstop the long end in some capacity, because if they don't, there's going to be some kind of crisis.
Yes, I do think so. I mean, if you step back, what's happened here is we've had 10, 15 years of very low interest rates, and what every single financial player, whether it's insurance companies, pension funds, hedge funds, whichever stripe of investment vehicle you can think of, has basically put on trades that benefit from low interest rates. And so when interest rates go up, we suddenly see what types of strategies people have had on, and we're seeing the unwinds, the rapid unwinds. So to some extent, we're going to see more of this. And the problem is that we've also had significant financial regulation since the global financial crisis. So there isn't that many market makers to provide liquidity into the market. So not only is the central bank the big buyer of bonds in general, it's also the market maker of last resort. Because banks aren't willing to be the dealer.
Is financial instability going to prevent central banks getting inflation back down to target?
Eventually, it possibly will be, but there's a path to this all, where we're seeing that we could have a path where we see sort of pockets of unwinds in different sectors, band-aids applied, then you start to see the central bank continue to hike to bring inflation down, and then much later on, when you start to really see the eyes of a recession, then you have a much bigger financial stability event.
Well, that bums me out. So it feels like a financial stability event and also entrenched inflation. Hey, Bilal, you got to help me out on where to protect your money then at this point.
Yeah, I mean, unfortunately, there's no easy way out. I mean, my bias has been throughout this year to be allocated almost as much as you can in cash. Cash doesn't earn you much; it earns less than inflation. But at least you preserve your capital. So the main challenge today is preservation of capital. If you put your money into equities, into bonds, you could lose significant amounts in that. So it's all about battening down the hatches, preserving your capital, have some cash ready and available to you when assets fall to distressed levels so that you can then deploy it and buy those assets.
How will I know? So the question here is, what does a bottom look like? And what kind of a bottom are we going to get? Because if rates go up and plateau and stay relatively high, does that mean that when the bottom comes into the market, we also you don't get the V-shaped bounce that we've got historically over the last few crises? Do we go down and stay down and then incrementally kind of creep back up again? Or do we get that V-shaped bounce? Because that's much more difficult to navigate.
Yeah, I mean, generally speaking, the way the market behaves is that it wipes out both the bulls and the bears. So yeah. My sense is the end point will be much, much lower in equities, real estate than where we are today.
S&P, give me a number.
I think we could easily go to 3,000, right. if not lower, for example. But we'll have these bear market rallies as well to take out the bears. That's the nature of markets. But the key thing here is that when I speak to investors around the world, many of them say we have cash on the sidelines. We can deploy it. Private equity has cash on the sidelines. Yeah. If you're still hearing that, that tells you we haven't reached the bottom. People are still feel kind of confident that, I can maybe bottom pick. So for me, that tells me we haven't seen the worst yet.
So what makes them rethink that? Like, what makes the eventual buy the dip really stop?
I think we see continued hikes by central banks. At Macro Hive, we talked about the Fed raising rates to 7-8%. We were laughed at the time. Now the market's pricing almost 5% for next year. So rates are going to go higher and higher and higher and higher to the point that will frighten everybody. And the challenge so far has been that the market keeps on thinking the Fed's going to do a few more hikes, then they're going to cut. A few more hikes they're going to cut. But
pivot.
Yeah, but each time the terminal rate keeps ratcheting higher.
So maybe when we stop talking about a pivot or a pause, like that's when we're going to see it at that point.
Yeah.
Hey, Bilal, really, really, really good to see you. Thanks a lot, Bilal Hafeez, Macro Hive CEO and Head of Research. Thanks a lot.